Hey everybody, the Dow just crossed over 23,000. It's time to celebrate. What better way to do that than with an episode of Young Bucks? Today we're talking a lot about earnings and what analysts think. We're going to talk about why that matters and why you should care about all that good stuff and touch on a couple of companies' individual earnings reports. Thanks for being here. Stay tuned. Hey everybody, welcome to What the Buck, the segment when we talk about all things money related. I'm Andrew Hall. Joining me today, Sam Frost, Matthew Krebsbach, and Ben Nye. How's everybody doing?
Good. Good.
Great. Speaking for the group there, Krebs. Jumping right in, talking a lot about earnings this week. I thought it'd be interesting to have a little conversation. We did a really great pizza illustration, good excuse to eat some food, and talked about the challenges of measuring earnings relative to expectations, but thought it'd be interesting to just have the conversation with you guys. Speaking specifically about the analyst community, I'll start with you, Ben. Do you think they're good at hypothesizing the amount of earnings and the important metrics that they're looking at with companies when they report their quarterly reports?
I think that for the most part, they're very good at extrapolating existing trends, and they're very good at, if companies give them guidance, if they know the revenue numbers, if they know the margin numbers, they're very good at, plugging them into the models and figuring out the result. The problem I think that they have is when something changes. So I think they're good at modeling when the trend is continuing and you're basically in a stasis in terms of the environment. When the environment changes, though, I think they can be a little slow to react and underreact in a lot of circumstances.
Krebs, you got any thoughts on this topic?
It always boggles my mind for like analyst estimates and stuff, like when, like Ben said, when it's like different from what they expected, like they just freak out, or like the investment community freaks out, and like it changes the value of that investment like 10% overnight. It's just like, wait, like let's say you're GE. Like I own GE one day, and then the next day they have earnings that are different than what consensus was, where analysts thought, and it's 10% down. It's like, wait, my investment dropped 10% because they missed earnings by 2 cents. It's like, it's crazy if you step back and think about it.
Yeah, it's kind of weird because it's almost like we've created this culture of sheep that just almost follows the analyst more so than they follow management. And I'm not saying that's always incorrect or always correct, but makes it difficult because you have to anticipate not only what a company's doing, but also anticipate the analyst community and their reaction.
Yeah, and also you have the idea of when analysts model something, if there's a company that always consistently beats estimates. So let's say they guide, which is they say next quarter we expect to earn 95 cents to $1 a share, and they'll come in at $1.05, and they'll do that repeatedly. Well, analysts aren't going to go out and say, immediately after management tells them, hey, Joe, we expect to do 95 cents to $1. Analysts aren't going to model $1.03 or $1.06. They're going to say, okay, well, they usually beat, but it would be a bad look if we modeled higher than $1. So they'll just model $1. And it's the same case if there's a company that expects to do $2 in earnings per share, and a lot of people think they'll probably do $1.50 a share. Analysts are going to be a little higher than $1.50 because the companies come out and said they're going to do $2. It would be a really bad look if the analyst modeled $1.50 and told the customers they'd earn $1.50 when management is telling $2. So they're going to follow management, but that means they won't be prepared when things change and when they change quickly.
Yeah, I think if I had to guess, the fundamental way that an analyst comes up, because I used to be always surprised. You look at the analyst revenue numbers, and they pinpoint a number. I'm like, how in the world do you come up with that number? And I really think it's just for reference for people watching this, it's just you take management's guidance, kind of like what Ben was saying. If they guide for $1 billion in sales, and then they have their own channel checks, they have their own things that they look at in the industry and whatever, and try to decide whether it should be up or down a little bit, and that's how they come up with their numbers. But it's always also been funny to me, to sit here and say that an analyst, and I get it here, we're mostly generalists, and most of the analysts who are writing reports are specialists, and so they cover 12 companies, one specific sector, and so they're much more in tune with it. But it's still silly to me to say that they're going to know the industry better than management does. When management is just focused on their company and their direct competitors, and then you have analysts who are a little bit can be more broad than that, come in and be like, well, we know it better than you, so we're gonna tell people what it is. And again, it's like management. I'm sure that this has trickled into management, but like they should just be trying to beat their own guidance, But it's kind of trickled into where even management wants to beat the guidance or the analyst expectations, which is just kind of a weird thing for management to feel like they're being almost bullied around by analysts.
Yeah, and it's a weird dynamic. I mean, you kind of have this like perspective, I guess, that would imply that, like you said, the analysts know more than management sometimes. But it's like the reality is that if that was the case, then your top analyst of a given company would actually be that company's CFO or COO or CEO, even making significantly more money than he or she is probably making, as an elite analyst kind of in the field. So it's definitely a challenge. It's definitely something you have to kind of navigate. Definitely something you have to keep in perspective as you're looking at all that kind of stuff. But just part of the game. And part of, we always say it's not just about the numbers, it's also about reading people. That's part of the challenge, is understanding how analysts, kind of think about things. And I think sometimes you almost have to analyze the analysts. You have to track them. You have to understand where they typically come in, kind of where they're positioned on the totem pole.
Yeah, because I'm going to say that there are times when you read analyst reports, or you can just listen to them on a conference call, and you're like, this dude is just bitter. Like maybe he had a buy on a company and, had a $60 price target on a company that was trading at $40, and then the company doesn't do the stuff that they think that they should have done. And then they just like slash the target. They're like, sell, it's worth $30 a share. And then they're just bitter the whole time, instead of being a little bit more even kill and be like, all right, well, I thought you had to do this to get the $60 a share. You're not doing that. So now I actually only think you're at $50 a share. Just like taper your estimates down a little bit based on what you wanted to see and didn't see. But you can really see that a lot of times people are just getting bitter.
So transition a little bit to talk specifically about earnings for one company in particular, UNH. Ben, you want to kind of take the lead a little bit on this and just talk it right through what happened, what they reported, what the story is, all that good stuff.
Yeah, so UNH is United Healthcare's ticker. United Healthcare is I think the largest HMO in the United States. So they provide health insurance. Nice thing about UNH though is that they also have captive businesses under the Optum umbrella. Now, this means that they do a lot of their pharmacy benefit management all through the United Healthcare system. So they essentially can negotiate their own prices. They're not relying on a company like Express Scripts or CVS to negotiate prices for them. And this is very good for UNH because that it means it can manage the medical costs better than their peer group. And that's being proven out once again this year. They're seeing medical costs that are below the industry and that are growing at a slower rate versus their competitors. It's a good competitive advantage for UNH. It's also good for their customers because that also means that they can have lower costs for their customers. Interestingly, for a company in the healthcare space, you say, well, just get admissions up, get medicines up, get that cost base up so you can get that revenue base up because you make a margin on that. UNH, that's not the case. In fact, admissions have been down on a year-over-year basis for each of the last 9 years. And this is something that they're quite proud of, and it distinguishes them from the rest of the industry. Moreover, the Optum business itself is much more than just pharmacy benefit management. It also provides a more cohesive set of analytics and data management for both providers and for patients that is different than what a lot of the other insurers are offering. I know, Andrew, you were at a conference lately where they talked a little bit about the Optum business. I didn't know if you want to expand on that.
Yeah, kind of the approach, and this was, I don't think it was insider information by any stretch, but a guy that works pretty closely with UNH. He's not actually an employee there, but kind of a consultant. And he just talked about how optimistic they are about Optum. Just the expansion of that, and so much of that plays on just kind of this big data, this idea of, hey, we have all this information on all of our customers. We know, kind of their pain points as well as their the points at which they're most comfortable paying certain amounts for certain services, things like that, and they're really able to kind of optimize so much of the care that they're giving and kind of give this almost smart approach to caregiving. And so it's really impressive what they're kind of doing there, and that's certainly something they expect to grow a lot over the next couple of years. And just a company that, again, when you look at how the stock's performed, it's pretty impressive.
I mean, they raised guidance once again, and they just have a habit of doing this, and I expect them to raise throughout 2018 as well. So I think that this is a company that's really it's the best-in-class operator It also has a best-in-class valuation, which sometimes is not the most attractive. But as far as a business perspective, I'm not talking about the spot stock. As far as a business, I think that they're doing the right things, and I think you should see continued good growth from them.
So definitely follow us on all our platforms for earnings updates. I know Ben's done a lot of videos. I'll probably jump in on some as well. You can check all those out on YouTube, youtube.com/Tusk LLC. They're also on our other podcasts, which is the Investing Podcast. And if you happen to be on Seeking Alpha, I think you can actually create a free account and probably access some of this, but seekingalpha.com, just search Tusk Media. All that stuff's up there. We try to stay on top of earnings as much as possible, but that's just kind of an example of one company we've been looking at and talking about this week. Market having a nice little push here, continuing to have that push. Seems like that's the theme every time we're talking about the market in general. The Dow over 23,000, closed above there for the first time today. We're recording this on Wednesday, and interestingly enough, it's already like more than 15% to the next major benchmark of 24,000. So it closed at 23,157. Crazy run. I mean, everybody's just kind of waiting on this pullback, rooting on it in some ways. It seems like everybody wants the pullback to happen just so they'll finally be proved right. But at this point, we're still kind of marching forward. Anybody have any general market thoughts? Any hot takes?
The only thing I'll say is just something we've kind of harped on, ever since the market started rallying. So right after the election, the market really just took off. And the entire time, we kind of bought into the fact of was it Warren Buffett whose quote, when people are greedy, you need to, I don't know what word to use.
Be fearful.
Be fearful. And when people are fearful, that's when the time to be greedy. And I think that still kind of applies right now. As the market's running up, everyone is just dying for a pullback on the news because they want to say they were right, that Trump was going to just wreck the entire world. And so everyone's just like dying for a pullback. And I think this is the exact epitome of people being fearful, and now's the time. I'm not to say be greedy, but I don't think
be disciplined.
Yeah, be disciplined right now. I think that's a good way to put it.
Yeah, and I just add on to that. We will be coming out with a macro slide deck that we come out with quarterly, so we'll be posting that on YouTube. So keep an eye out for that, where we're really digging to these in detail. But just kind of as a teaser, we're talking about tax rates and the expectations for tax rates and expectations for tax cuts, and those have actually come down in our opinion. And in addition to that, we think that regulation environment has improved, and also be watchful out for these passive investing strategies and the effect that could have on pro-cyclicality. Pro-cyclicality means that market moves either up or down are accentuated. So be watchful on that. If the market does start to have a significant down move, it could exacerbate itself because of these passive investing strategies.
There you go. And now to the thing everybody's here for, football picks. Real quick before we really dive in, Ben, your Washington Huskies, the first one of our teams to lose a game this year. I'm going to just give you a second. I don't know if you have any thoughts, any remarks. They're on a bye week, so it might be a good time to kind of clear the air.
Yeah, I mean, I think that they deserve to lose that game. I mean, you can make a...
He's not mad. He's disappointed.
I mean, you can complain about the fact that they missed 2 field goals from 20 yards out.
I would.
You can complain about the fact that we had an O-lineman get out injured, that our defense, which played stellar actually for the majority of that game, and actually the opposing quarterback, the Arizona State quarterback, threw a ball which hit one of our corners' helmets and bounced into the hands of a tight end on 4th down with 3 minutes to go in the game. We would have got the ball back. We didn't even get the ball back. And so we lost, and it's disappointing. And we're going into a bye week, so this is going to be 2 tough weeks. Quite frankly, I'm not even thinking about the playoffs anymore. I'm just hoping we win a game, to quote Jim Moore. So we just need to get better, especially on the offensive side. I think we need confidence. We have a very much lack of confidence on the offense. We're not throwing the ball with zip. We're not running the ball with aggression. And we're not running deep routes. And we need to do that to open the games.
Sounds like your team's just bad. I want to give Ben credit here, and I'm really not being sarcastic. He's been saying for months that Washington would lose to an Arizona State team that nobody thinks is that good.
It's hard to win in the desert.
It's hard to win in the desert. He's been saying it for months. Georgia also on a bye this week, so we're not going to be picking that game. Number 3 in the country. It's whatever. Wisconsin, a 24-point favorite against Maryland. Who's at home?
Wisconsin.
Talk to us.
So Wisconsin's the number 5 team in the nation. I think they should be at least number 3. Just kidding.
They've played a tough schedule.
Cupcake schedule.
Like I said, that game's in Madison. Maryland's strength is their offense by far, and Wisconsin's strength is their defense by far. I have a hard time seeing Wisconsin score above 35 points, anyways, and I see Maryland scoring a touchdown or 2, so I'm taking Maryland there. I think they'll win by like 20.
I got Maryland.
I got Maryland.
Man, I have Wisconsin.
All right.
Alpha.
There we go. Alabama, a 35-point favorite against Tennessee. This is a cross-division rivalry against a dumpster fire Tennessee program. Sam, talk to us.
Yeah, so Alabama's the number 1 team in the country.
Great point.
And, like you said, this is a big rivalry. And I think back to, was it 2009? It was the first national championship that Alabama won with Nick Saban. And Tennessee about ruined those hopes when they Alabama blocked the field goal. It was a super short field goal at the end of the game. Tennessee would have won. So I don't believe Tennessee was very good that year either. And so honestly, to me, like, it's kind of a toss-up, but Tennessee just keeps proving week after week how bad they really are. And so I think as long as Alabama doesn't just have a complete brain fart, I think they're fine. I think I mean, not fine. They're fine to cover. Like, they'll win, but that's a big spread. But I still went with Alabama.
I got Bama.
Yeah, Alabama.
All right. And I guess this is the ABC game. Penn State, a 10-point favorite against Michigan. Another just electric Big Ten matchup. Krebs, you're the Big Ten guy. What are you thinking?
Well, I think you and me feel the same way about Michigan. I mean, like they haven't played a good team yet, really, and they haven't looked good yet, really. I mean, they just can't score. The quarterback threw, I think, 5 picks against Michigan State, right? It was raining, but it's 5 picks.
It's tough to do.
That game's in Happy Valley, which is one of the hardest places to play in the country, in my opinion. I think I can't remember what I picked on this one. I'm going Penn State though.
I'm taking Michigan just because I really dislike both of these teams, but I dislike Penn State more, and I'm just going with my heart, not my head here. But I think you're right, but I'm going with
I think
Michigan.
Penn State just pulls miracle. Like
Yeah.
I don't think they're good, but they just somehow pull it out.
Yeah.
Maybe that means they're good.
See, I'm giving Harbaugh the benefit of the doubt and going with Michigan.
I say Penn State, but just let's pause for like 20 seconds and just complain about how bad ABC picks games. I mean, ABC is owned by Disney.
What are you talking? That's a great game.
Yeah, so there's
they're picking-
zero. Like, this is the worst year of college football.
They
ever.
always
There are
always
no
pick
good games.
Big Ten games. They always pick Big Ten games. It's like
That's
Penn
just
State
everyone's
is the
ranked in the
second comer or
conference.
something.
Have you looked at what games are being played?
Penn State hasn't done anything. Penn
Okay.
State has not done anything. I would watch Alabama versus Tennessee over
No, you
Penn
wouldn't.
State.
You don't mean that.
You mean that until like the
Until
second
it's
quarter
like
and they pull their
21-0 in the
starters.
first quarter. I agree.
Yeah.
I think it's going to be 21-0 in the first quarter, Penn State, Michigan. Michigan is quite possibly the most overrated team in the FBS.
Wow.
Sam could have picked USC at Notre Dame, but he wanted this one.
USC and Notre Dame is far more marketable.
Wow.
That's because those are like two bigger names.
But they can't pick that game because it's going to be on NBC. I think, like, all things being equal, they would have it. NBC owns all the Notre Dame games,
Keep in mind, game days at Penn State, though.
which is like the only. I mean, that's the logical place for them to be this week. Generally, I agree with you, Ben. Like the Michigan State game, I complained about it a lot on this podcast.
That was
Like,
a great game.
It was a crap Michigan team against an unranked Michigan State team, and Michigan State won. Like that, it's unreal that was a primetime game.
Yeah, no, I agree with that. The only reason I
Monsoon.
went with the Penn State Michigan game is I think Michigan has a better. Ben will completely disagree. Michigan has a better shot at upsetting Penn State, and then like the USC Notre Dame game, like I don't think anybody cares who wins that game.
I will say that game, like Southern Cal and I'm not arguing with your pick. I'm like fine with this being the game. I think Southern Cal or Notre Dame, either one of them could sneak into the playoff. Like if things broke right and they kept winning.
Yeah.
I mean, Notre Dame, they lost to an excellent Georgia team, but they've won every other game by 20-plus points. So,
I don't really care USC, Notre Dame, Penn State, Michigan. I don't care which one we pick.
So what would you have on primetime this week?
I mean, there's
I
no
don't know
good
the
games.
There's really not. There's just.
But
there's
but
not a
I
lot.
I think that the media loves Penn State. The media loves USC for some reason because they played in a very high scoring game with no defense in the Rose Bowl. I mean, football is about offense and defense, and neither team had any defense. And now USC doesn't have an offense, and by the way, neither does Penn State. They just have a running back. So, sorry.
I think that I will say I think like there's been so many upsets that like if you laid out the plan in terms of teams you would think would be like high profile teams to watch, like this week we have Florida State, Louisville, which like going into the preseason, like that game's going to be lit. It's going to decide that division in the ACC. You know, potentially whoever wins that and whoever wins the Clemson matchup between those, that's going to be the decider. But then it's like neither of those teams are ranked right now, so that's probably a big disappointment for them. Oklahoma lost earlier than they wanted. Oklahoma State's taken one on the chin. Like it's kind of one of those where it's like,
LSU
Washington's
lost
lost.
to Troy.
LSU's lost a lot of games. Washington lost, and they're off this week. But I think it's about as good as they could do this week. I'll give them that. But that's all we got. Y'all stay tuned. We'll talk to you soon. Bye. Hey, everybody. Today we're going to be talking a lot about earnings, and that's a really important topic for investors all over the place and something that I think a lot of people kind of misunderstand to some extent. So couple things I wanted to talk about when we talk about earnings. First things first, what exactly is earnings? What are they? What does that mean? When people talk about a company's earnings, what are they talking about? I think the most common misconception from a lot of people out there is that earnings is some kind of hard to understand nebulous figure, something that only analysts will be able to understand. And the reality is that's not exactly the case. So a couple things to think about with a company. When you look at the top line of a company, when people talk about the top line, what they typically mean is sales or revenue or the amount of money that came into the company. So for instance, let's pretend that Tusk Media, the proprietor of this Young Bucks show, makes $10 in ad revenue during the course of a quarter. That's $10. We're really hitting it big. We're big time like that. They make $10. That's not actually your earnings figure. That's the amount of sales or the amount of revenue that they made. So let's pretend that to make that $10, we had to spend some money. We had to do a lot of things. We had to pay the very talented people on this show. We had to pay a very talented producer of the show, Mr. Reggie Moyer. We had to do all this kind of stuff. We had to buy some equipment. And let's just pretend for a second that that total amount of expenses for the quarter was $5. So all the money we spent to make this show was $5. The reality is that would be a huge pay increase for most of us here, but also to scale of what we're trying to demonstrate, that matters. So over the course of that quarter, a $5 bill goes straight out the window, and that means we can generate $10 in revenue. But we spent $5 to do that, so that means our actual earnings, the amount that we have after all of our expenses, is $5. So Tusk Media generated $5 in earnings. Now, why does that matter? Let's actually talk about a couple things. Get this money out of the picture and switch gears a little bit. It matters because people invest for a reason, and the main reason people invest is not to lose money. It's not to participate in downside. If you're out there and you're saying, I think this company can really go down in value and can really lose me a lot of money, don't buy that stock. Don't be long that position. So people are actually doing the opposite. They're investing because they want to participate in the upside. And the upside can be a couple different things. Maybe it's a dividend. You know, you own shares and they send you a couple bucks every quarter, things like that. Maybe you want your shares to get repurchased at a higher price, or maybe you're just looking to hold something for the long time and you're looking at stock appreciation. You're looking for the stock to trend upwards. Those are, you know, kind of the general reasons why people invest. They want to grow their asset value. They want to grow their portfolio account. They want it to go up in value. And a big part of that is participating in the upside. And that upside is best reflected oftentimes by earnings. So let's talk about something even more fun than money. Let's talk about pizza. So when I order pizza, what am I doing? Well, it's kind of like investing. I'm sending money away, money that I can no longer use again, at least for the time being, with the expectation that I can participate in something good, something very good, you might say. Now, what am I hoping to participate in this case? We're talking pizza, folks. So the idea would be, hey, I send out money, however much this may cost at your local pizzeria, and I say, hey, at the end of the day, what am I getting? I'm getting to participate in this pizza. And here you have a nice full everything pizza. You got some peppers, you got some anchovies, you got all kinds of good stuff on here. It's going to be great. That's what I am expecting to get from this. Now, what gets interesting if you're thinking about investing is how quickly my expectation for this pizza can change because of a number of factors, and that goes for earnings. If this is my reward, imagine the things that could adversely impact my experience. Let's say I order this pizza for myself, and all of a sudden I open this up and say, wow, this looks really phenomenal. I got 1, 2, 3, 4, 5, 6 slices of pizza here. It's a medium, didn't want to go for the large. 6 slices of pizza, and all of a sudden the doorbell rings, 4 or 5 people show up. Well, guess what? My reward just got diminished. That's not a great thing for me because my participation in the upside, my participation in the positive things of this pizza are going to go down on a pro rata basis, and we call that dilution. So when you see a company issuing a lot of shares, diluting shareholders and saying, hey, these are the good things, these are the earnings, the dividends, whatever it may be, but now you got to share it with even more people, that tends to be something you don't like. The other side of that is maybe I order this pizza when there's 6 people here and all of a sudden 3 have to leave. Companies that reduce share counts by getting rid of people that want to lay claim to pizza, that's a good thing for you if you own that. So what else can really shift things? Let's imagine when you buy a stock, you have a certain degree of expectation, and hopefully that's an informed opinion, either coming from an investment analyst, an investment advisor, or just doing your own research and listening to other analysts say, hey, we think this company can generate X amount in earnings. There's an expectation. So the amount of earnings matters, right? We talked about that with Tusk Media in terms of we generated $5 of earnings. That matters. That's better than $4 and not as good as $6. But what really matters is what the expectation is, what the market expected. Because if Tusk is a publicly traded company and people thought we should be able to generate $6 in earnings and we only generate $5, guess what? Everybody's going to be really disappointed. So when I order a pizza, like I've done so many times before, even in this very video, if I order a large or a medium everything pizza and it shows up to my door and all of a sudden I look at it and I say, oh my gosh, I'm missing a piece of pizza, I'm going to be disappointed in those earnings because I expected to earn a full pizza. I wanted all of that. I wanted the right to all of that. I didn't want to share it, and I certainly didn't want anything to be missing. So when we talk about expectations, it's really easy to see how things can get off the tracks for a stock by missing on earnings expectation. If you get 5 slices instead of 6, that stock's probably going to go down. Conversely, if you get 7 slices, all of a sudden there's a piece just sitting right there in the middle on top of it, or maybe there's some wings thrown in that I didn't order, hey, that stock price might actually go up. Another thing we talk about a lot is the quality of earnings. So all earnings are not created equally. And what I mean by that is sometimes the target may be $5 on earnings for a company like Tusk Media, and they hit that target, but they do it in ways that may not be quite as legitimate as people expected. So for instance, maybe we get $5 in earnings, but then you look back and you say, well, to get there, they had to buy another podcast that was also generating revenue. So they made a good acquisition, but that was a one-time event. And guess what? That old podcast, it's not going to be able to maintain its old strength because they haven't retained the talent from that previously existing podcast. So yeah, sure, this quarter, Tusk Media made $5, but it's unlikely to happen again. So when we talk about quality of earnings, what we're really looking for is what's the true core replicable amount of earnings. So let's say that I hop on the phone, I call Marietta Pizza Company right down the road, and I say, you know what? I want a medium margarita pizza. I could get something like that, and that'd be exactly what I ordered. But with a margarita pizza, you got to be really careful because when you order a margarita, you might also end up with something like this. Now, what's wrong with a margarita? Nothing in and of itself, but that's not what I expected. That's not the quality of earnings I was hoping for. Now, perfectly fine beverage that I'm about to enjoy, but is that what I expected out of earnings? These are the things that matter with earnings. It's not all that complicated of a topic. Just think about pizza. You want as much of the pizza as you can possibly get. You want the same flavor of pizza that you ordered, and you want it to show up in a way that you expect. You don't need any kind of fancy drink to go along with it unless that's what you ordered. There you go, folks. That's earnings. Enjoy the rest of the show.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.